Welcome back. It is time for our power table, and we are looking at the rand, of course. And according to the IMF, South Africa's rand is one of the most traded and volatile currencies in the world on a GDP basis. And as a result, forecasting the rand's outlook is pretty complex and pretty tough for traders and companies alike. And one of the costliest examples that we have in our recent history here in South Africa is that of SAA, which suffered a 6 billion rand hedging loss in its 2003 financial year and had to be bailed out by the government as a result. So the question we're asking is to hedge or not to hedge. And I'm joined by Sluis-Cremer, a forex trader at Rand Merchant Bank. Also, Cilliers, director at TreasuryONE, and Bianca Botes, director at Peregrine Treasury Solutions. To all of you, welcome and thank you so much for joining us in studio, and thanks so much for your time. So before we get into the discussion, we put this question out to the audience, to our followers on the social media, and this is what they had to say about whether it is prudent to be hedging South Africa's rand right now, particularly for companies. And based on those results that I'm looking at on the screen, majority says yes. Just given the fact that the drivers, rand drivers specifically, are complex. Interesting comment about amateurs also being able to trade there. But it looks like a unanimous yes. But let's get into this discussion. And Jan, I want to start with you. Simply put, hedging is just all about protecting yourself from the rand going in either direction. But technically put, just explain to us and unpack what hedging actually involves.
Yeah, 100%. So hedging basically is, if you're an importer, you want to protect yourself from rand depreciation or dollar strength. And if you're an exporter, you want to stop your position from losing ground should the rand strengthen.
Sure.
That, essentially, in a nutshell, is what hedging is.
Sure. Bianca, would you add anything to that definition?
No, I think he covered it completely as well as you probably could in layman's terms. I think the important thing about hedging is actually getting that certainty of outcome for both importers and exporters.
Okay. So, Andre, if you then kick off the discussion for us, should we be hedging the rand right now? Is that a no-brainer in your view? Or are there nuances as to who should and who shouldn't right now?
Well, first of all, when we speak about hedging, it's not as simple as just to say hedge or not to hedge. I think the absolute start of the whole discussion should be you have to know what your exposures is that you actually need to hedge. Because in a lot of cases, even an exporter might be exposed to certain amounts of import risk because they're importing certain amounts of stuff as well before they can actually export. So then you have to determine what is your net exposure between your exports and your imports so that you actually know exactly what to hedge. Then also you have to look at how exposed you are. Is some of your exchange rate risk transferable by contract to your buyer from you or not? So it's not as simple to say hedge or not. You have to know what your exposures is that you actually need to hedge and what you're exposed to in terms of exchange rate risk. Then they answered the question to hedge or not to hedge. You ask them, what is hedging? I want to add to that, it's very simple. Every individual, in most cases, try and take out a medical aid in case they get a heart attack. And that's hedging your risk in terms of your health. Buying insurance policy that if you get into an accident that you can claim for your car that was written off, that's hedging your risk. So analyzing your risk and then deciding what to do with it to take the volatility out of the exchange rate and take the volatility out of your income statement and balance sheet. And I think that's the question that you need to ask.
Okay. And thanks for asking it for me. And if we just to pick up from there, and I think that very nicely put in terms of the analogy to an insurance policy akin to taking out medical cover. we were talking about this off air. You were last in studio prior the pandemic. In fact, we were in a different studio then. And I'd just like to reflect on the different environments right now and the ease of taking out that insurance policy on the currency right now. Back then, pre-pandemic, compared to what you have had to do in the recent while.
Look, I think pre-pandemic, there was still a bit of a case of people would, monitor exchange rate risks, and, they may have bought a forward exchange contract or sold some in the spot, and perhaps the more sophisticated guys would have probably looked at a few derivative products. But certainly post-pandemic, and I think people have started to see what's happened when supply chains dried up and currencies, blew out and came back again. And, you need to be able to understand and manage that so much better today in today's environment. If you just take a month ago, the rand was where we are now. Sure. You might have got an invoice in at 18.50 rand, and you going, leave it in my intro, I'll get to it tomorrow. And then tomorrow the rand's at 19.50 rand. So you've lost a rand. Whereas your competitor who imported that same product, he was perhaps a little bit more on the ball, and he covered. So now you running at a loss, you've got to increase your price of your product, so you become uncompetitive. So, I think post-pandemic, guys are really starting to look a lot more closely at currency hedging across the spectrum. It's no longer just a case of, if you're an exporter 10, 15 years ago, Andre can attribute to this. If you're an exporter, you just left your dollars in your bank account, and in a month, 2 months, 3 months' time, the rand was always weaker. Today, you get these volatility swings, and you can't do that. Sure. Because if you miss that upswing, you might be busy with something else, and then you look tomorrow, and it's 2, 3, 4% lower. So people have definitely woken up to the fact that, to optimize and to manage the currency, especially with the swings that we see now, hedging has to be part of your ballpark.
Mm-hmm. Bianca, in terms of the comparisons in environments, and I'd like to correct you from Citadel. Bianca Botes from Citadel joining us. How do the different environments compare? Because, if you extract COVID-19 and the disruptions to the supply chain, perhaps that's one of the more newer risks that the world and South African investors have faced. Volatility and geopolitical uncertainty and even local uncertainty has been the name of the game for some time. I'm reminded by Nenagate in 2015 when the rand also did all sorts of crazy stuff that I'm sure left a lot of people in tears. How do you compare the two environments, pre and post-COVID, in terms of hedging, and what are some of the differences that you have seen?
I agree that we've seen a lot more interaction from clients looking to hedge their positions and wanting to manage that risk. I think what COVID taught us is that a black swan event is only a stone throw away at any given time, and there's a lot of contributing factors to that. We are living in a globalized society, in a globalized world where we are interdependent on the actions of other countries. The recent Russian-Ukraine war being one of those, the falling out that we've seen geopolitically in South Africa because of our believed closeness to Russia or friendliness to Russia, the fallout between China and the US, those are all factors that impact on currency markets. And the rand is not excluded from those contributing factors. When we start looking at currency performance, the rand, what risk we actually need to protect ourselves against, we have to take into consideration that the currency market is a global one. And as you mentioned earlier, it's one of the most traded currencies in the world. So we would be very naive for South Africans to not look at optimizing their hedging strategies, not protecting against potential fallout in the market. So I think the pandemic has really brought that to top of mind and has informed us that, these type of events can happen at any time, unexpectedly, and you need to be covered against them.
Sure. And Andrea, I'm sure you'd also like to add your comment there, but as you do, I'd also like to ask you exactly what it takes to move the rand in volume and value terms. Are we talking $2,000 US, $2 million? I won't go beyond that. But exactly how much it takes to move the needle on the currency and cause huge bouts of volatility that we have seen in the recent while.
Okay, so if I were to add my 5 cents pre-pandemic and after post-pandemic, I don't think that the principle of hedging your exposures has changed in any way. That principle has stayed exactly the same. What have changed is one have to relook at the strategy that you follow. There's a very wide choice of products available in the markets. You can outrightly buy some dollars or sell some dollars to cover your exposures in terms of imports or exports, or you can follow certain strategies where you do have some advantage to the upside if you were an exporter by doing a zero-cost collar. But there's all sorts of products available in the market. So a new look at the products and your strategies is most probably very valid post-pandemic, because the volatility levels have increased significantly in the post-pandemic world. And the uncertain and, as it was mentioned, black swan events like a war, like a pandemic, has become more evident. So one needs to relook at your strategies and the way that you hedge. In terms of what moves the rand, different amounts at different times, but certainly not something as low as 2 million. It is definitely in amounts of 500 or 400 million and more that is really needed to move the market. But in terms of when and how, it would depend on what's the event that occurs, what's the availability of liquidity in the markets, because we find that in times of great uncertainty that your liquidity is a little bit less. And if your liquidity is a little bit less than the amount that is needed to move the markets, obviously becomes less as well. But there's days that there's massive amounts of liquidity that a 700 million rand amount, a $700 million amount wouldn't really move the market. And then there's days that a 200 million or 100 million could move the market, depending on what is the event that took place and the uncertainty surrounding it.
Sure. No, very valid points. As we have seen market liquidity being impacted by whoever's on public holidays, for instance. But I want to come back to you, Andre, and drill into some of the hedging strategies that you are looking at and you are adopting right now. Before that, just another comment that has come through from our external audience on this particular conversation on Twitter. Just waiting for it to be brought up right now. Okay, that's taking its time. Let's talk strategies then, real quick. Okay, it's finally up. Dipuo Hendrika talking about the fact that, yes, you should hedge the rand. South Africa is quite liquid. The currency is quite liquid. Anything, geopolitical tensions, economic volatility can trigger a sell-off that could potentially lead to a drop in company earnings, which we have seen in the recent while. But specifically going back to the topic of hedging strategies, Andre, so how does your strategy to hedge the rand differ when you are hedging against some of the major currencies? You're talking dollar, the euro, perhaps even the yen and the yuan, externally, compared to how you hedge as a company or trader if you are looking to manage currency risk or political risk on the continent, i.e. looking at stuff that's happened in Nigeria or Angola or even Zimbabwe that has cost companies a penny or two?
Okay, so even if I look at the question that was asked by the external audience now, if you were to protect yourself, for instance, let's say you were an exporter and today you have to make a decision as to how do you hedge future exposure of dollars coming into your account that for stuff that you've exported. Now, you could simply pick up the phone, call a bank or call your advisors and say, you know, I need to hedge and I want to sell €1 million, for argument's sake, forward for a period of 12 months. Now, two ways that you can do it. On an outright FEC, you would fix the rate, and you would get a rate plus some forward points in your favor because of interest rate differentials, and you would end up, if you look at the rand where it's currently trading around the 2030 plus around about R1, then you would end up with a forward rate for 1 year around about 21.30. Or you could say, I only need to fix my floor so that I have a minimum known amount of 20.30, and I need some upside potential to hedge against unforeseen circumstances. We have an election coming up that might throw some turmoil. We don't know what happens with the war in the Ukraine, and there's all sorts of possibilities that can happen. So I need some upside potential as well. And then you could put a cap on it, which we would then refer to as a zero cost collar. And then you'll likely get an upside potential to most probably levels of around 22, which simply means that in a year's time, when that contract falls due, you will look at the spot market where it's trading then. If it's below 20.30, you will be able to exercise your position at 20.30 and sell your euros at that level. But if there was a blowout because of something unforeseen that happened, and the rand trades at 22.5 against the euro, then you would be taken out of your position at 22, which then simply means that you got some 70 cents better. And anything in between those two levels, you would be able to sell at the spot rate in the market because it's either above the floor or below the cap. So that would be one hedging strategy.
Sure.
In terms of what you can do rather than just taking out a normal forward. But obviously it would depend on what's the composition of products that you already have in your book, the amount of exposure that you're hedging, etc. I always recommend that nobody ever hedges themselves to 100% because you don't know. If you take an exporter, for argument's sake, in the agricultural sector, and let's call it, for argument's sake, they're in the citrus industry, you don't know. You might be provide for a 10 million euro exposure, but somewhere in the middle of the season you have a hailstorm or something happens and you're not able to export everything that you initially thought that you're going to export, and then you only end up with 7 million euros of income. So if you had hedged 100%, then you would now end up with an FX position that's overhedged. So,
Sure.
You know, it depends on the company, it depends on what they do, and that's why I started off by looking at the exposures.
Okay.
You must know what you hedge so that you can know how to hedge.
All right. Great. Got it right there. I saw the both of you nodding as he was speaking, so clearly agreeing to some of the comments that he was making. But yeah, I just wanted to ask if you had a comment regarding the kind of volumes and the amount of volumes, even in value terms, that were required to move the rand.
Yeah, look, I mean, I agree with Andre. I mean, it depends on a day-to-day basis, literally, on what the liquidity is and, you know, what's going on in the global markets in the currency world. I mean, yesterday, for example, we saw lots of importers around, so there was a lot of demand, $4 at the lower 1845 levels, and at the time there was a natural kind of a flow of sellers to offset that demand. Now today that dries up, so there's no sellers around, so now suddenly to buy those same dollars that people were looking at buying yesterday is now chased the rand up to 1860 because those natural sellers aren't around. And then also just so you can't say, well, you know, 10 million today, 100 million tomorrow, 1 billion the day after. It really depends on the market at any given time of the day what liquidity is looking like. You know, at 7:30 in the morning, $20 million could move the market because there's not much liquidity around, because Europe is still kind of, making their way into the office. The US isn't open. Asia's closing down, so liquidity's drying up there. Whereas at, say, 10 o'clock in the morning, liquidity could be a lot stronger and a lot better because you've now got the whole European market in. And it kind of comes in ebbs and flows. There's no defined time, defined amount, what can and can't move the rand.
Okay.
And also to come back to on Andre's theory of hedging, I mean, there's no perfect science to hedging. And I think that's where people sometimes get themselves, a little bit kind of wound up and they go, well, my financial advisor or my bank said I've got to hedge. Well, there's no perfect science to hedging. A hedging plays out over a long period of time. So it's no use today if I'm exporting, what did Andre say, apples or citrus, and we get struck by a hailstorm. Hedging policy has got to be over time. And you're going to win some, you're going to lose some, but over time it should work in your favor if you hedge correctly. And take the portfolio, as Andre said, you don't go and hedge 100%, but, hedge 50%, leave some open in case, you've got to import a new tractor or something, so, that you're not then caught on the wrong side of the spread. There's many ways to skin that cat.
Sure. So you're nodding there as well. And I'd like to know if intervention from governments or central banks in their currencies makes the hedging equation a lot more difficult. I mean, right now there's a lot being said around the Japanese yen and the action that the Chinese are taking with regards to the yuan in supporting their currencies. And does that make or influence how a South African investor hedges in any way?
I think it's important to understand that from a governmental or from a regulatory perspective, there's intervention across all markets. Okay, when we look at central banks, they are actively intervening all the time. The latest interest rate hikes is just one example of that. But central banks moves to fight inflation, but also look at price stability in those specific markets. Some mandates are a bit more comprehensive, like the Fed actually looks at after full employment as well. In South Africa, our Reserve Bank looks after inflation combat as well as price stability. When you kind of understand that notion that there is intervention on a global scale all the time, it paints a picture that, yes, it is something that you need to take into consideration, but it also happens on a global scale. So it's not a matter that only one market is actually taking central bank action or only one government is intervening in that market. It happens on a regular basis across the globe. So yes, there are incidences that will move it more than others. So when we see interest rate hikes by the Fed, it tends to strengthen the dollar and the rand will come under pressure. But the rand will also then strengthen, should theoretically strengthen, when the SARB hikes interest rates. Unfortunately, that didn't go in our favor the last time. But theoretically, the rand should then strengthen when the SARB hikes interest rates. And similarly, the Australian dollar should strengthen when their central bank hike rates, and so on and so forth. So I think it's important to understand the global market dynamic at play, understand it's not single country risk, and actually come up with a strategy that filters those type of fundamental elements into your strategy. You can't just take a strategy where you are saying, I'm only focusing on data, or I'm only focusing on central bank action, or I'm only focusing on technical elements. There needs to be room to maneuver, and that ties into the argument that Jan and Andre made, is that you cannot go and say, I'm going to put my full exposure into an FEC or into a zero-cost collar for that matter. It needs to be something that allows for the dynamic action in the market to actually filter through into your hedging.
Okay. Just a follow-up question then on the management of currency risk and the intervention in the market that happens everywhere, as Bianca has made the point. So does that apply, or does that influence hedging in terms of managing currency risk on the continent? And I'm going to go back to the question that I did ask Andre. Just given the fact that no Rand Merchant Bank has quite a number of clients on the continent, and you've had a number of clients who have had sleepless nights not being able to get their money out of the continent in areas like Nigeria, like Angola, for idiosyncratic factors that have faced those specific countries. So how does it differ Are there nuances, or is it the same?
No. There's plenty of nuances, especially going across the African continent. I mean, no, and we had this discussion earlier today. You know, if you take the Nigerian naira, for example, you know, 2 years ago, Nigeria was the flavor of the month. People were climbing into Nigerian naira. They were buying Nigerian T-bills because they were offering attractive yields. The currency was stable. Then all of a sudden, COVID comes along, the oil price falls out of bed, and Nigeria just shut down the exchange market. And you can have the best hedge strategy in the world in place. When something like that happens, it's not worth the paper it's written on. And that, unfortunately, because the markets are not as developed across Africa, it becomes that much harder to go and put a hedge on. So if you exporting, so generally the way the guys work, if you're exporting, I don't know, apples to Zimbabwe, you'd probably charge the importer in that side in US dollars, because you want to receive US dollars from him. That you can hedge against the rand or whatever. You don't want him sending you Zim dollars because there's nothing you can do with it. And you can't hedge that because there's no hedging capabilities in country in Zimbabwe to manage that type of risk. So you've got to take literally each and every African jurisdiction and have a look at what the rules and the regulations are like, as well as what the liquidity is like in those markets. So today in Kenya, you could probably sell in the interbank market $1 million or $2 million. But if you go across the border into Tanzania, you could maybe only sell $250,000 on any given day. So each country in Africa has its own little nuance. It's not to say that, you know, South Africa, well, I can go and buy and sell $10 million and it's, you know, it's easy come, easy go. In the African countries, there's a lot of rules and regulations, of red tape, liquidity, how dynamic that market is set up, and what you can and can't do from their own central banks' exchange control ruling. So you've got to also look at that. So you'll generally find if you're exporting across Africa, you're going to invoice the guy in dollars, and you just want dollars because that's the easiest way to alleviate that type of risk out of Africa.
Except for now, and I've got a follow-up discussion in my mind about what happens now when conversations and actions regarding countries actually settling trade in their own currencies happens in a lot more frequently. We do know one of the development banks, Afrixim, is championing that with its payment system, but that's a conversation for another day. We have to wrap up, but I just want to close this discussion saying that, okay, to hedge or not to hedge, that wasn't the correct question we should have asked, but what we have received in terms of answers is that it is difficult out there, it is complex out there, but it's really important to know what your exposure is and what you need to hedge. But Andre, I was hoping that you could finish off and give us the last word on this conversation.
100%. In your wrap-up now, you went back to exposures. That is the absolute ultimate. You cannot hedge anything without knowing what you hedge. And there's two things when you look at exposures. There's actual exposures and expected future exposures. And these two things will demand that you take different hedging strategies for your actual and for your future exposure, because future exposure might not materialize, whilst actual exposure is something that's definite and requires a different strategy. But I made it easy by speaking about a medical aid. Nobody takes out a medical aid hoping that he or she will have a heart attack. And that's something that a lot of people always forget when they do hedge, is that when they've hedged and the hedge goes underwater, they regard it as having lost money. That's not having lost money. That's actually just not necessarily that you've exercised your medical aid because something happened, and that's protecting you. So yes, I think clients should always hedge. They should always have a strategy, but very importantly, added to that is there must be a policy in place. And the policy should be written to manage the risk of the company and not to manage the exchange rate. And you should never allow the movements of the exchange rate to manage your policy. The policy is there to manage your risk within your company, within your sustainable risk profile, in ensuring that your company can go forward year in and year out and ride out any extreme events or black swan events.
And we'll put a full stop after that comment. Jan, thanks so much for your time. Rather, Andre, thanks so much for your time. Bianca, what am I doing? Bianca, Jan, I think the program has been going on for too long. But to all of you, thanks so much for providing this analysis for us. Jan Sluis-Cremer, a forex trader at Rand Merchant Bank. Andre Cilliers, currency strategist at TreasuryONE, as well as Bianca Botes, she's a director at Citadel. That's how we wrap up Power Lunch Southern Africa for today. Thanks so much.